The news of Shell's intention to exit South Africa after a dispute with its BEE partner, Thebe Investment Corporation, broke on May 5, 2024. However, the actual story is far more intricate and complex than a single news article can convey. Even the information presented in this video may only scratch the surface. With a 122-year history in South Africa, Shell's exit is not a straightforward process. The key question is, what motivates Shell to want to exit? After reading numerous articles, reports, memos, and media releases, I will attempt to distill the most critical information into this video. Please stay tuned, as there are fascinating insights that will help you make sense of this media frenzy. In the fuel and energy industry, upstream and downstream refer to the two main segments of the supply chain. Upstream operations involve the exploration, production, and processing of oil and gas reserves, focusing on finding and extracting raw materials from the ground. This encompasses searching for potential reserves, extracting oil and gas from wells, and processing the extracted resources to separate and treat crude oil and natural gas. The process includes drilling, completing and operating wells, as well as transporting the extracted resources to processing facilities, ultimately laying the foundation for the downstream operations that transform these raw materials into finished energy products. Downstream operations revolve around transforming the raw materials into finished energy products, which are then distributed and sold to consumers. This process begins with refining crude oil into petroleum products such as petrol, diesel, and jet fuel, followed by marketing and retail efforts that bring these products to the end users. Through a network of service stations, convenience stores, and other retail outlets, downstream operations ultimately deliver energy products to power vehicles, homes, and businesses, connecting the raw materials extracted during the upstream operations to the everyday needs of consumers. Think of it like a river. Upstream is the source of the river, exploration and production. Downstream is the flow of the river, refining, marketing, and retail. In the context of Shell's exit from South Africa, the company's upstream operations might include extracting oil and gas from local fields, while its downstream operations would involve refining and marketing petroleum products for local consumption. This is where SAPREF, which refined 35% of South Africa's crude oil, comes in. SAPREF, South African Petroleum Refineries, the largest crude oil refinery in South Africa, located in Durban on the East Coast, is a joint venture between BP South Africa and Shell Downstream South Africa. It was established in 1963 and began operations in 1966 with an initial capacity of 122,000 barrels per day. Expansions and upgrades over the years increased the capacity to 350 barrels per day, becoming one of the largest refineries in Africa. However, in March 2022, the refinery's shareholders announced an indefinite pause in operations, citing the need to consider various options, including a possible sale. Currently, it's not in operation. The most preferred option for the shareholders is a sale of the refinery. Until a decision is made, including a possible change of ownership, no further investment will be committed. Thebe Investment Corporation was founded in 1992 as a pioneering black-owned company. It was established by the Bato Trust to support historically disadvantaged South Africans. It opened for business in July 1992 with an initial capital investment of 100,000 Rand. The Bato Trust is a community-based trust that was also founded in 1992 and was the sole shareholder of Thebe Investment Corporation at the time of its founding. The Trust's original members include Nelson Mandela, Walter Sisulu, and Reverend Bayes Naudé. Though some shares were sold off over the years, the Bato Trust still owns 46.79% of Thebe Investment Corporation. Thebe Investment Corporation's initial involvement in the petrochemical industry began with Bambanani Petroleum, which was established in 1997 as a joint venture between Thebe Investment Corporation and the Italian oil company Eni. This marked the company's entry into the downstream petroleum sector, with a focus on marketing and distributing petroleum products. Bambanani Petroleum was later renamed TEPCO Petroleum in 2001 and continued to operate as a subsidiary of Thebe Investment Corporation. Through TEPCO Petroleum, the company was involved in the importation, storage and distribution of petroleum products and had a significant presence in the South African market. In 2002, Thebe Investment Corporation sold its subsidiary TEPCO Petroleum to Shell South Africa, initially retaining a 17.5 to 25% stake in the merged entity. Shell Downstream South Africa was formed in January 2015 through the merger of Shell South Africa Marketing and Shell South Africa Refineries. Following this merger, Thebe was able to acquire additional equity, thereby increasing its shareholding to 28% in the newly merged entity, Shell Downstream South Africa. TEPCO became a wholly owned subsidiary of Shell Downstream South Africa, and Thebe Investment Corporation ended up with 28% of the shares, valued at around $73 million at the time. The current value of the shares is not clear because they are not traded. Thebe values the stake at around $200 million or 3.7 billion rand. Allow me some speculation and fiction. Firstly, Thebe Investment Corporation owns a 28% stake in Shell Downstream South Africa, SDSA, but these shares are not traded. So their value is based on complex calculations that include a combination of assets, production value, and retail performance over a period that can vary depending on mutual agreement. This is where the devaluation comes in. The main asset of SDSA is the SAPREF refinery, which is currently not producing anything since it was shut down. It has no production value, and much of its infrastructure was damaged in the KZN floods of April 2022. Do you recall when over 50 workers had to be airlifted to safety after the control rooms and the refinery were flooded? SAPREF accounted for 35% of South Africa's refining capacity, but with aging systems, a massive capital investment is required to get it operational again. The 600 service stations are franchises, so they have operational value but no asset value. Shell wants to divest its 72% stake in SDSA, so it's not interested in the 28% stake, as this would mean buying something at a value and trying to sell it again as a total 100% stake. This is how the 28% share value became essentially worthless. Any new owner would also need to consider that they would need to work with Thebe as a 28% share owner of their operational business. In the world of big oil, few moves go unnoticed. So when Shell announced its intention to withdraw from downstream operations in South Africa in 2022, the industry took note. Thebe Investment Corporation saw this as a potential threat to their investment. Thebe faced a potentially devastating loss of share value, and in an attempt to protect their interests, Thebe attempted to sell their shares at a value determined by themselves rather than Shell. It was a bold move, and one that would set off a chain reaction of negotiations, disputes, and ultimately a stalemate that would leave both parties at an impasse. Shell's strategic withdrawal from South Africa, ending a 120-year tenure, is indicative of the broader challenges faced by the refining and marketing segments of the global oil industry. This move to divest from its downstream operations, including a network of around 600 plus service stations, is a proactive measure to circumvent sustained losses and reallocate focus towards more lucrative ventures. Regular portfolio assessments are customary for companies like Shell to enhance asset optimization and resource allocation. The decision to exit is likely a component of a larger initiative aimed at operational streamlining, cost reduction, and the pursuit of opportunities with greater growth potential. While some may point to South Africa's empowerment regulations, specifically broad-based Black Economic Empowerment, BEE, as the primary reason for Shell's exit, it's essential to note that this is not the sole factor. However, BEE complexities have likely played a role in the company's decision-making process. As a business owner, imagine facing a similar dilemma. Continue investing in a market with increasingly stringent BEE requirements, or opt for a more straightforward investment opportunity elsewhere. The allure of a BEE hassle-free environment can be tempting, especially when considering the significant resources required to ensure compliance. In Shell's case, the cumulative effect of various factors, including BEE complexities, has led to a strategic decision to exit the South African market. This move will undoubtedly be closely scrutinized by industry experts and analysts. Other factors include the aging infrastructure of the currently shut down SAPREF refinery in Durban. Another aspect is the cost of reinvestment in modernizing service stations for electric vehicle charging, a key aspect of Shell's latest energy transition strategy. With plans to divest from 1,000 service stations globally in 2024 and 25, South Africa's stations align with this strategy, making them suitable for divestment. The cost of upgrading these stations for EV charging may have been a significant consideration in Shell's decision to exit the market. Ultimately, Shell's exit from South Africa is consistent with its overall strategy to reshape its downstream portfolio globally, so BEE was not an only factor. When Shell exits South Africa, the company will likely leave a smaller sub-brand, Viva, in the country, retaining a percentage of ownership in its petrol stations. This means that Shell will still have a presence in the country, albeit in a reduced capacity. Viva will be a smaller, more localized entity, with Shell retaining a minority stake of around 20% in the business. The majority ownership of around 80% will be held by a local partner or partners. This arrangement allows Shell to exit the country while still maintaining some presence and influence in the market. Viva will likely operate a subset of Shell's current service stations, potentially around 600 locations. The Viva brand will likely maintain some connection to Shell, potentially through branding or licensing agreements. This means that customers will still be able to recognize and trust the brand, even if Shell is no longer the primary owner. By leaving Viva behind, Shell can gradually reduce its exposure to the South African market, while still benefiting from the brand's legacy and customer loyalty. The exact details of Viva's operations and ownership structure may evolve over time as the transition unfolds. However, it is clear that Viva will play an important role in Shell's exit strategy from South Africa. Do subscribe to my YouTube channel, as I have a few more stories to tell. I will catch you in the next one.